Good afternoon. This is Josh here at Chaikin Analytics, and I'd like to welcome you to our presentation of Profit from Earning Surprises. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics. Chaikin Analytics is not registered as a broker-dealer or investment advisor, either with the U.S. Securities and Exchange Commission or with any state securities regulatory authority. Chaikin Analytics is for educational purposes only and is not a trade advisory service. Past results of any trading system or methodology do not guarantee future results. As a reminder, this webinar is being recorded, and a copy of the recording will be available to everybody tomorrow. Please submit any questions you have via the Zoom Q&A window, which you can access along the bottom of your webinar screen. Now, to get us started, here's Marc Chaikin.
Thanks, Josh, and welcome everybody. Title of today's webinar, Profit from Earning Surprises. We're in the middle of earnings season. It's been a challenging earnings season. We're going to talk about why and how we see the balance of earnings season playing out and where the opportunities are, both from companies due to report earnings and from companies that have already reported earnings. So a little bit of my background: 50 years on Wall Street. For 45 years, I've been using technical analysis, but always in conjunction with fundamentals. And that's enabled me to survive 10 bear markets. Been a lot of chatter on CNBC, particularly in December, less so now in early February, about whether we were heading into a bear market. Our answer was always no, although the official benchmark for a bear market in terms of the S&P 500, the large cap index, is 20% down on a closing basis. Ironically, we were down 19.89%. But one way or another, this market has righted itself, and this market really speaks to how successful investors have made decisions in the 50 years I've been in the market. I've been mentored by some of the smartest and most successful institutional investors, and they always follow a plan. And the successful money managers, whether they're value managers, hedge fund managers, stick to their plan. And this has been a market where you had to stick to your plan in order to survive, because the volatility that we experience, as we'll see in a minute, in December and then again in January on the upside, has been unnerving to investors. Along the way, what I've learned from these successful institutional investors has been incorporated into what I consider to be the culmination of my life's work, the Chaikin Power Gauge rating, which really sums up the fundamental factors that successful investors look at every day. It's taken me way beyond the technical indicators that I've been known for, like Chaikin Money Flow and our volatility bands. And we're going to talk about the Power Gauge rating and how it can be your GPS during earnings season. But before we get into specifics on the Power Gauge and individual at what this market's been doing, we were on an uptrend on autopilot in 2017 and also for a good part of 2018. And that's given way to roller coaster corrections, which, as I said a minute ago, are very unnerving. Here's a one-year chart of the SPY. This is the most actively traded instrument in the US markets. Mirrors the S&P 500 index. And at the bottom of the chart is our new Power Gauge rating for ETFs, which has been bullish for the SPY on the way up. And when we look at the price action, we see a very mixed bag in terms of conventional technical analysis. We have support and resistance levels identified very clearly on the chart. On the way up in 2018 in August, July and August, when we broke through 2,800, we were on the way to new all-time highs. The NASDAQ and the small cap IWM had already made that, and this was considered a very bullish confirmation as we headed into that September peak. And then the chairman of the board of the Federal Reserve, kindest thing to say is he misspoke. He was new at the job, and the messaging part of the job was new to him, and the market didn't react what he had to say about the future course of interest rates and what was going to drive them. So we broke through 2,800 on the downside, what had been resistance, and then support becomes resistance again. We traded down to 2,600, and we thought back in late November that we might get a W bottom at that 2,600 level, very similar to the W bottom that we got in February and March of 2018. But in December, we hit a perfect storm of negativity, and the factors have been well documented. But the reality is that the W bottom just never happened, and we went down and almost turned that 20% magic number of a bear market into reality. And just as we had a waterfall decline of 4 weeks, we've now had 5 straight weeks to the upside. And this has really been a difficult climate for people. We're going to try and show you how to handle it using the tools that we've come to rely on over the last 8 years at Chaikin Analytics with our clients. So just to put pullbacks into perspective, when you get declines of 5 to 10%, we call that a pullback. There are lots of them, almost 80 of them since 1945. Good news is they're over quickly. They average 6%. The average time is a month, and you recover to new highs. That's why you hear people say buy the dips on CNBC, because most of the time that's right. However, there have been 30 instances now since 1945 of declines of 10 to 20% in the S&P 500. We call that a correction. The average correction is 13%. This one was 19.9, and the average length is 4 months. The market peaked in September. 4 months takes you to the end of January. We're through that 4-month average period, and we're on our way, I believe, to recovering to new highs. Now, once you've made that midterm low, which we did at 2350 on the S&P 500 on what I call the Saturday of the Christmas Eve massacre on the 24th of December, once you've made that low, here's what your potential is. Based on the 4-year election cycle going all the way back to 1950, you average a 32% rally from that midterm low. 2350 times 32% gives you the potential to move above 3,000 on the S&P. That was our target in 2018 for the market. We got to 2940. Looks like we have the potential to go there again. So we're going to try and find ways to buy stocks, take advantage of the potential in the pre-election year, the market rallies from that midterm election low. Now let's look at the market a little more in depth. This is a weekly chart, courtesy of stockcharts.com, of the S&P cash index. And you can see that deep V-shaped bottom that we've been talking about. But normally, when you see a big spike in new lows, that red bar at the bottom of the chart, you come back down and test those lows. This is not a normal market, and this is not a normal earnings season. We're going to tell you why and what it means for the strategies that have worked so well over the past 8 years during earnings season. But what the takeaway from this chart is that normally you get a test of the lows, but we're now 6 weeks into the bottom, going on 7, and there's no sign of a retest. And the reason is, and the reason that this time is different, is that in the first 2 rallies that we got in October and November, off the 2,600 level all the way back to 2,800, remember these are steep 200-point advances, there was no bread thrust, meaning that we didn't achieve this magical level of 95% of all volume in up stocks on a given day. However, after the Christmas Eve massacre and the market bottoming out at 2350, we've had 2 of them. And Marty Zweig, a very famous money manager and stock market technician, identified this pattern over 30 years ago and wrote an article in Barron's. And the bottom line is, when you get 2 bread thrusts over a 2-week period, it's very bullish for the market 6 to 12 months out. That's why this time is likely different. And that goes against everything I've always preached. Any time I heard someone say this time was different, I said, maybe, but it rarely is. This time truly is different. We're in uncharted waters in that a test of that low at 2350, even though there are still some people on CNBC calling for it, seems, if not impossible, very unlikely. So the challenge for investors is how you find opportunities, not just in earnings season, but in the market in general. Now, our scenario for 2019 is the same as it was over the last 3 years. higher interest rates and rising earnings. And rising interest rates, in spite of what the market said in October, November, and December when rates were rising and the Fed was unclear as to when they might stop raising rates, higher interest rates when earnings are rising is bullish. And the reason is there's more loan demand, stronger economy, you should get rising interest rates. In this current market environment, interest rates are still relatively low, but this is a very bullish scenario, another piece of the puzzle to say, let's try and find stocks to own. Now, fear gripped the market in December. That's what happened. That's why we had 4 straight down weeks. And CNN has done an excellent job of creating their fear and greed index. It's a sentiment indicator, which is what we call a contrary indicator. When people are in a mode of extreme fear and panic and reacting negatively to anything, whether it's good or bad news, this gauge will go deep into the red, as it was just 1 month ago. It hit a low reading of 6 on a scale from 0 to 100. It's now moved back up into the greed zone. That's not bearish for the market, but it shows you how volatile the market's been. A month ago, extreme fear. We're now into greed and moving toward extreme greed. So what do you do in a market that's so volatile, that's gone from despair to euphoria in just 5 weeks? Well, you listen to Warren Buffett, who said investors should be fearful when others are greedy, and greedy only when others are fearful. So the real buying opportunities that were staring us in the face back in December were really difficult to take advantage of because everybody got caught up in the negative emotions. Even Wall Street analysts did, and that's what we're going to be looking at the balance of the webinar. Analysts started cutting their earnings estimates heading into the fourth quarter earnings season, which began the second week in January. That's made it very much easier for stocks to beat Wall Street estimates, and we'll see why that's important in a minute. So I'd like to pose a question to everybody, and Josh, why don't you walk us through the question and the possible answers?
Sure. So the question is, are you finding buying opportunities in today's market? The answers that we have for you are yes, you are, no, because you're bearish, or everything's overbought. What you like is overbought. So we'll give you a few more seconds just to fill in these answers, and then we'll share the results with everybody. All right, here we go. Let me close this down and share it with everybody. Almost 70% say yes, Mark.
Wow. That's impressive. Not the fact that only 5% of the people are bearish, but that you're actually finding buying opportunities. This is a difficult market to find buying opportunities, so that's quite impressive. And if the problem is what to buy and when to sell, our solution is Chaikin Analytics, and we're going to now talk about how you can use our very disciplined approach to buying and selling in a market where you're looking for buying opportunities. Now, everything we do at Chaikin Analytics is driven by the fact that fundamentals drive the market. But emotions drive the market to extremes. And we saw that painfully in December, and we're seeing it again right now. The path to profits for me has always been a combination of fundamentals and technicals. And because of that, we've gotten a pretty good following from people who actually are really good stock pickers and traders, people like Dr. J, John Najarian, and Jim Cramer. And good write-ups on our methodology, our group and stock selection in Barron's and Forbes and on CNBC. It's because we have this unique combination of fundamentals and technicals. But simple is better, and so we distill our power gauge rating down into a gauge that looks very much like the gas gauge on your car. Simple display, but very powerful, with a lot of number crunching going on under the hood. And the power gauge rating can be your GPS during earnings season. Now, in past earnings seasons, we've had wonderful setups with the power gauge rating and our buy and sell signals. This earnings season is different, just like this rally is different in my view. So let's take a look at what is in the power gauge and why earnings season is so important to it. The power gauge cuts through the clutter of the fundamental data that analysts and portfolio managers use every day to make decisions, which we see pictured on the right, and distills it down into a gauge that we see on the left, in this case, a very bullish rating for Starbucks when it was trading at 65.92, and that's one of the slides we're going to talk about here toward the end of the webinar. The power gauge rating looks at value, growth, technical, and sentiment factors. And in each of those 4 primary factors, there are 5 sub-factors. The value metrics are 35% of the model. Earnings metrics look at the world slightly differently than a conventional fundamental analyst. We love earnings surprises. When I was at Drexel Burnham in the mid-'80s, one of my mentors, George Douglas, did the original research on earnings surprise and how when companies meet, beat, or disappoint Wall Street analysts, it affects how they change their estimates. And that's a big short-term driver of stock price movement. It's happening as we speak. Analysts cut their estimates coming into earnings season. That's normally very bullish. And because of that, it's been very easy for companies to beat analyst estimates. The bar was set very low. We also like industry group relative strength. Stocks tend to herd. They respond to the macro factors that make industry groups strong or weak, which are not a short-term phenomenon. So the model is unique in that it distills these factors that successful investors look at every day into a rating that you and I can use. And the model has worked for 8 years, as we'll see in a second, because it's based on how Wall Street works. It's based on what successful investors have been looking at for the 50 years that I've been in the market. And the proof is in the performance, both in sample and in real time since 2011, when the model was first released to the public. Average very bullish stock in the Russell 3000 up 20%, average very bearish stock up only 1%. And that's after a 10-year bull market. So if you focus your long positions on the very bullish stocks, avoid the very bearish stocks, you stay out of trouble, you sleep better at night, and you put the odds in your favor. Now, in 2015, when energy stocks were in their own bear market and so were small caps, it was really important to know which stocks had bearish power gauge ratings, just as it was in 2018, when there were many, many stocks that went down as the market was making new highs. Because in 2015, the very bearish stocks, the Range Resources, the Kinder Morgans of the world, were down an average of 17%. So avoiding those stocks or buying put options or put spreads on those stocks resulted in superior performance for people who understood how important fundamentals are to the market. Now, Jim Cramer has become a big fan. He used to be a client and loved Chaikin money flow, but since we've introduced the power gauge rating, he's extolled the virtues of this very simple approach. He said, I want to explain why I love Marc Chaikin stuff. It's simple, it's understandable, it's rational, it's not emotional, and you know I use it constantly, almost never want to go against it. And he said that in a one-on-one webinar that we did in November, right after the midterm elections rather. So let's look at a pattern that we've talked about in these webinars with Jim and that we've stressed in client webinars for the last 7 years. We call it a classic Chaikin bull. The power gauge rating is bullish, meaning that the fundamental potential for a stock is strong. It's outperforming the market, so the technicals have confirmed the fundamentals, and Chaikin money flow is strong, indicating that institutions are accumulating the stock. So let's look a little more deeply in this one-year chart of Microsoft at a classic Chaikin bull. I like to read the chart from the bottom up. I would imagine most of you look at the price first I always look at the power gauge ribbon at the bottom of the chart. It goes from red to yellow to green, and from sort of late 2017 through October of 2018, power gauge rating on this one-year chart of Microsoft was green or bullish, and the stock was outperforming the market until just very recently. Now, when it broke its long-term trend line back in October after the market peaked, about a week later, the power gauge turned neutral, and it stayed neutral because Microsoft is a quality company with very strong free cash flow, which is one of the factors in the model. It didn't get hurt as hard as some of the other tech stocks like Apple and Amazon, Nvidia, and Facebook, but it hasn't come back as well either. And because of that, it's starting to underperform the market. Now, just a word about Chaikin Money Flow. I know many of you have used Chaikin Money Flow for years on your online brokerage platforms or on stockcharts.com. Normally, when money flow is green, to the extent that it is for Microsoft and almost every other stock, we view that as extremely bullish. Time to buy the dips. It's different this time because of the way money flow is computed. It's 21-day moving average, which means that the number you drop off is as important as the number that you add in. We had 4.5 straight weeks of down into December 24th, and we've had 5 straight weeks of up. It's going to take about 1 more week before we can start relying on money flow the way we have for the last 35 years. Now, here's the classic bull. Power gauge bullish, outperforming the market. Chaikin Money Flow shows big periods of green indicating that institutions are buying the stock. And then you're looking for buy signals, what we call low risk entry points. We also highlight the earnings on the chart, and you can see that Microsoft, with this green earnings surprise indicator, has beat analyst estimates for the last 4 quarters, including the one that was just reported. And going back, we'd see another 2 or 3 quarters before that. So a solid company with the classic bull pattern up until October, outperforming not just the market, but Wall Street analyst estimates, is the classic bull, and these are the stocks you want to try and buy. Now, the market is complicated right now, and we've come through a period of distribution, and we're now, in my view, breaking out of a base for many, many, many stocks. Stocks that were beaten down badly, not just in December, but in the whole June through December period. As the market was making a new high, many stocks were in their own bear markets. And I believe we've now broken out, and we're going to see an example of that in the financial stock on the next slide. And we're in sort of a new era type bull market, in my view. With everybody on CNBC cautious and calling for potential tests of the lows or not really committed to the rally, we're starting to see stocks like Synchrony Financial, which was spun out of GE, break out of that base period. That's the Wyckoff pattern that he developed over 90 years ago. Richard Wyckoff, famous market technician, based on his reading of charts and human emotions, he developed this idealized pattern of how stocks go up. And because human emotions haven't changed, the pattern is still working almost 100 years later. So Synchrony, on the strength of a very, very positive earnings surprise and a very strong reaction to it, has broken out of that base, and we're now looking for a pullback to buy the stock. We don't want to chase the strength. This is a little different than the classic Chaikin bull. You might almost say that this is a classic bull in the making. And that's one of the challenges you have as traders and investors. So a lot of stocks look like this right now. You're not in that classic uptrend of higher highs and higher lows that are so much easier to spot. You're breaking out of a base, and there are many stocks like Synchrony that we could be looking at. Now, classic bear, exactly the opposite. Power gauge is bearish, underperforming the market. Chaikin Money Flow is red, not green. Wynn Resorts has been our poster child for classic Chaikin bear through most of 2018. Casino business, particularly in Macau, was not good. We had a number of opportunities to get out of the stock before a major collapse. And notice that there were a series of negative earnings surprises where the company disappointed and the stock gapped lower each time in July and then again in October. And that's why we say this earnings season is different, because Wynn reported disappointing earnings. They missed by 30 cents on January 30th, but yet the stock has moved higher. This earnings season is different. In July and in October, when companies were reporting second and third quarter results, there was a sell the news mentality. This quarter, investors and traders are much more forgiving. Companies are having an easier time beating estimates, and the reaction to earnings, even when companies disappoint, unless they don't disappoint too badly, has been positive. Again, looking at the chart from the bottom up, power gauge rating bearish, underperforming the market, institutions selling. We look for sell signals. I'll just go in depth on this one signal here because it's my favorite of all the 6 pairs of buy and sell signals in Chaikin Analytics. We call it our relative strength buy and sell signal. If a stock is underperforming the market, and our relative strength heat maps makes it easy to know because it's red if it's underperforming and it's green if it's outperforming, and there's a neutral zone, a band of about 20 points. If it's underperforming the market and rallies above its 21-day average and then drops below, and that's the 21-day exponential, that triggers a relative strength sell signal. The reason I like this signal is they tend to last 4 to 8 weeks. And in that period, you can benefit from a well thought out options position. You can sell the stock if you're stuck in it. You could have sold Wynn up here at 155 on a way to 90 with confidence, knowing that there is smaller likelihood that the stock's going to reverse back to the upside anytime soon. So everything we've been talking about can be encapsulated in this pyramid. It is the discipline methodology that we've been preaching in and out of earnings season for the last 8 years. Power gauge rating and industry group strength are your go-to fundamental indicators at the bottom, Chaikin money flow and relative strength, and then in the middle, that sweet spot, the buy and sell signals. This methodology and the power gauge rating give you what we call a directional edge. The probability that a stock is going to go up or down is enhanced when all these factors are in play. Now, Warren Buffett has also said that they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. He calls it the fat pitch. We call it the ideal setup. And the trigger for the ideal setup is when one of these 6 pairs of buy and sell signals trigger. You can go to our website, chaikinanalytics.com, where we explain the rationale behind each of these 12 buy or sell signals. But one thing that's clear, both in and out of earnings season, is you have to know that these signals have triggered. And the way we do that is twofold. We have a dashboard. This is from our iPad app, but we also have it on the desktop that tells me which stocks in a list I'm following have triggered buy or sell signals on a given day. And you can also see a broader list like the S&P 500, or in fact, any list in the system has an associated alerts signals dashboard. So on January 8th, Omnicom, which is an advertising agency worldwide, triggered a relative strength buy signal at 73.75 on its way to 79 this morning. The stock had a neutral power gauge rating because that doesn't factor into this particular signal, but it had been outperforming the market, and it triggered that relative strength buy signal, as many stocks did coming off the December 24th lows. That's why these signals are so important. But we also heard from clients that they don't necessarily log into Chaikin Analytics every day. They try to, but sometimes they're traveling or they're tied up in business meetings. Because of that, in May of 2018, we launched our daily alerts email. Every morning at 8 o'clock, we send out to our subscribers the signals on stocks that they're following that have triggered based on the previous night's close, and also any important other information like rating changes or earnings estimate revisions. So on November 9th, two stocks in the energy complex, which had been weak, triggered sell signals, and I zeroed in on HFC, HollyFrontier, because we had been extremely bullish on the refining stocks, and HollyFrontier had a bullish rating and had a really powerful move up to the $80 area. But where that first arrow is where that relative strength sell signal triggered 65.75 on the way down to 46. Now, just prior to that, HollyFrontier had experienced what we call a bearish personality change. Notice how our relative strength indicator went from green to red, went from outperforming to underperforming the market. That's a really powerful pattern. We're starting to see it in reverse now. We saw it in SYF, Synchrony Financial, where it's gone from underperforming to outperforming, and we're going to see it in Applied Materials in a minute. But the key is knowing that you had a signal, particularly with Chaikin money flow red, and there's a pattern there that we're going to talk about in a minute that hasn't been officially documented by any of the online brokerage platforms. So this is valuable additional way to use Chaikin money flow. This was a great opportunity to get out of the stock, to put on a put position, to be ahead of the curve. Now, I believe so strongly in these personality changes that I call them the key to making and keeping profits. So you've got to have a way to spot the personality changes, and it really is quite easy. Here's Applied Materials, which makes semiconductor equipment, manufacturing equipment, along with Lam Research, enjoyed an extraordinary bull run in 2017 and 18 as the chip makers like NVIDIA, Advanced Micro, were having a field day. But then you had that bearish personality change with the stock under its long-term moving average back in April when the stock was trading around 53, 54. Now, when we get a bearish personality change, we look for the first sell signal as an entry point. Just as with Synchrony Financial, we got a bullish personality change. We're looking for a buy signal, some sort of pullback that meets our criteria to get long the stock. But that first sell signal on Applied Materials came at 49, and the stock ultimately bottomed out under 30. Now, if you look at the right-hand side of the chart, you see something interesting. This is that breakout from the Wyckoff base. Power gauge rating is now bullish. Company reports earnings on February 14th, a week from Thursday. It's now beginning to outperform the market, and you've broken that downtrend, which has been in force since April. Important to know about these personality changes. Now, one other signal, and then we'll look at some very specific stocks to sort of pair this up with how you can make money. This is a sell signal that will make you a lot of money. We call it the Chaikin bearish money flow sell alert. It's sort of a stealth pattern based on how institutions take advantage of strength to distribute stock or take advantage of weakness to accumulate stock. So we're going to use Mohawk Industries, MHK, as our poster child for that. Mohawk makes carpet. They've been negatively affected by the weakness in the home building stocks. But notice that when it rallied up and got overbought back here in April, and then again in August, Chaikin money flow, instead of going green, which was the normal pattern that I created over 30 years ago, stayed in the red. That meant that smart money, institutional money, insiders were selling into strengthen the stock. And the original money flow alert in the stock came at the all-time high of 280 back in January of 2018. So this is a really powerful pattern. This happens to be a stock where the power gauge and relative strength were bearish, so the market agreed with the model, and you had enormous institutional selling. So if you see that institutional selling and the stock gets overbought, in this case it triggered relative strength sell signals. Again, you can see the 4 to 8 weeks playing out so beautifully. A couple of negative earnings surprises and downward gaps. And again, Mohawk reports earnings after the close on February 7th. And I said this earnings season was different. And the way this could play out is that stocks that have been reacting negatively to disappointing earnings may not have the same ability to drop that they have in previous earnings seasons, July and October. We'll see. And we've got a good example with Electronic Arts, which is holding true to form, that reported after the close. I'd like to talk about playing good defense, because earnings season is really all about playing good defense, using options to establish positions in volatile stocks that are due to report, being vigilant about companies that are in your portfolio that are due to report earnings. So playing good defense is all about avoiding risk and making money on the downside. So here's what risk looks like. This is Halliburton. In the very weak oil, machinery, services, and drilling group, the group is still weak. It's been weak for over a year. Trends persist in the market. That's why industry group relative strength and our power gauge ratings for the industry groups are so important. If you could have seen these relative strength sell signals, if you could have spotted the Chaikin bearish money flow sell alerts, you could have been out of stocks like Schlumberger and Halliburton. Halliburton triggered that relative strength sell signal at 43 on the way to 25. If you can avoid stocks like this, and be mindful that the market made new highs here in September. So being out of the Halliburtons of the world ahead of that new high was very good for your bottom line. And again, we look for that first sell signal as our entry point. Here's another stock similar to Wynn, Halliburton, Mohawk. This is Whirlpool, same industry group as Mohawk, home furnishings and appliances. Whirlpool has had a heck of a time, bearish earnings surprises, power gauge bearish, underperforming, institutional selling. The pattern repeats over and over and over again. These are our overbought sell signals. Excellent spot to have gotten out. They work about 66% of the time. The relative strength signals back tested about 70% accuracy. But these are short-term trading signals, 5 to 10 trading days. Now, Apple is another example where the discipline methodology that we showed you in that pyramid could have identified a stock on the decline. So we see on the bottom of the chart the bearish personality change in November. The power gauge went bearish at a price of about 212 under the long-term moving average. But the most interesting thing about the Apple chart is the bearish money flow sell alert that happened when it made its all-time high of 230. On a new all-time high in the most largely capitalized stock, and by the way, it's now the most biggest stock in terms of market cap yet again. But on that move to 230, when it put on a $1,200,000 market valuation, look at Chaikin money flow. Red, not green. Smart money was exiting the stock. And then we got the power gauge turning bearish at about 212. Analysts started cutting their estimates. Then they didn't like what Tim Cook told them about not reporting unit sales anymore for the iPhone or the iPad. And there was a whole downward spiral in Apple. And the power gauge remains bearish through this whole rally. Doesn't mean Apple can't go up. It means we're not looking at it for buying opportunities. Let someone else make money in Apple when the power gauge rating is bearish. Now, Citigroup is another stock where the power gauge rating had been bullish, but you got a bearish money flow sell alert on that rally up to 74. These patterns repeat over and over and over again. If you can spot them in and out of earnings season, you're going to have winning trades over and over and over again. And you can get out of some of these stocks on strength, just like the smart money was doing back in September on Citigroup when it rallied up to 74. Now, one final example, because NVIDIA is a stock that Jim Cramer talks about all the time, that the analysts on CNBC are conflicted over. They're in every hot market, from Bitcoin mining, which has gone south, to artificial intelligence, to self-driving cars, you name it, they're there. And they had a huge run, absolutely monster upside. And the power gauge rating was bullish for part of that. But the power gauge rating turned bearish on October 5th at a price of 260, just barely down from the high of 280. And then Goldman Sachs upgraded it to a conviction buy 2 weeks later with the stock at 240. You need tools like the power gauge rating and Chaikin relative strength and these money flow patterns in order to navigate earnings season and manage your portfolio and your trading account. Goldman Sachs ultimately threw in the towel at 140 and said we were just dead wrong on this stock. But if you've been following the power gauge methodology with the bearish personality change, the bearish power gauge rating, negative money flow, you would have been out of NVIDIA and not tempted to buy it when Goldman Sachs upgraded it. Now let's look at earnings season, because that's the topic of the webinar. And as I said, it's been a very challenging period for earnings season. We've been an advocate for the last 7 years since we've been doing these webinars that you can make money during earnings season if you have a directional edge, the power gauge rating, your GPS to tell you which stocks are likely to outperform or underperform Wall Street estimates, because stocks are volatile in these 4 times a year, January, April, July, and October, when they report earnings. But we think and have thought that volatility equaled opportunity if you were better prepared by knowing which stocks were likely to disappoint or beat Wall Street estimates. This earnings season has been different. And I'll go back to the Warren Buffett quote. They don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. This has been an earnings season where you needed to be very selective. Most of the opportunities in earnings season are coming after stocks report, not before. Now, this is what an ideal setup looks like. This is a chart of Best Buy going back to 2017. It gave a buy signal. This is our oversold buy, with the stock making a new 8-day low with a bullish power gauge rating ahead of an earnings report. And we recommended an options position on a webinar back in May of 17. And the stock reported a positive earnings surprise, which is exactly what it had done 1, 2, 3 times before. And it did what it had done back here in August and November of 2016. It spiked up. And that spike took the stock all the way from 50 to 60. And we got this very nice testimonial. This is what we try to do in a normal earnings season. Put on a low risk, low-cost options position ahead of an earnings report, knowing with some degree of confidence that a stock is likely to beat or miss estimates. Again, this earnings season has been different. It's been a challenge. We're not seeing these wonderful setups like we saw here in Philip Morris in April, when my associate Dan Russo, who writes our Morning Insights, made Philip Morris his bearish stock of the day ahead of that earnings report. Everything was in line there. Power gauge was bearish. The stock was underperforming. Chaikin money flow showed institutional selling. That's another example of that bearish money flow sell alert. And yet another earnings disappointment led to a gap down in a very profitable options trade. This earnings season has been different. But in order to trade earnings season, or to be prepared if you're sitting on stocks from the long side, as many people were in, let's say, Boeing, heading into earnings, you have to know which stocks are due to report. So every week in my weekly market insights, I publish this earnings calendar, which is also a visual of the list within Chaikin Analytics. So I know, and our clients know, which stocks are due to report earnings in the coming week. So we're going to look at a couple of these stocks. Regeneron is due to report tomorrow. Electronic Arts, EA, reported after the close. And then we're also going to look at Boeing, which reported last week. So let's take a look at Regeneron. First of all, I note that in the last 2 earnings seasons, even though the company exceeded Wall Street estimates. The stock did not respond well. We had that sell on the news mentality that we've been talking about from the July and October earnings seasons. And the stock, when it spiked up, was a good sale. In this earnings season, stocks that spike up are not necessarily good sales. They're tending to continue higher. The reaction to earnings has been very positive. Remember, the bar was set very low by Wall Street analysts. So the last signal in Regeneron was triggered back here in December, coming off that December 24th low. Regeneron, which had been outperforming the market, this is a very major biotech and drug company, moved back above its 21-day average. That was really the last opportunity to get in. When they report tomorrow, do I see opportunity in the stock? The answer is no. Why? Because it's at the top of the page already. It's near our upper volatility band. It's making new highs. I don't know how it's going to react to earnings. Even though analysts are raising estimates, they're going to report before the opening tomorrow. I don't have strong conviction. So following Warren Buffett, you don't have to swing at every pitch. Not a place where I feel that I have an edge or we can give our clients an edge. Now, here's Electronic Arts. The reaction to the last two earnings reports was negative. I had a trader at a major trading room ask me today, late in the day, what I thought about Electronic Arts. And my answer was, the power gauge is bearish. It's underperforming the market. But this earnings season is different. Now, it turns out that Electronic Arts disappointed. The stock is down. It was up 4 points before earnings were reported at 4 o'clock. It's now down 6 points. So you've had a 10-point swing. Volatile earnings season, very difficult to trade unless you see a clear-cut edge. Now, a lot of people have been bullish on Starbucks. Starbucks has already reported earnings, and you can see the herky-jerky nature of the market. The reaction to Starbucks earnings initially was a sell. Back here before those earnings, Goldman Sachs downgraded the stock. It traded under 62, but the power gauge was bullish, outperforming the market, and the stock has continued to make new all-time highs. This reaction to earnings is really what we've been talking about. This has been a challenging earnings season, very difficult, and will continue to be. But the good news is that companies are not being punished the way they were in July and October. Even companies that disappoint, with Electronic Arts being the exception, have followed the money and moved up in this 5-week rally that we've had. Here's another example with Boeing of a stock where the power gauge turned bullish in mid-January. But when the earnings came out, the stock was already overbought and sitting there at the top of a big rally. And with a very bullish earnings surprise and a market that had been weak, the stock attracted a lot of buyers and moved over 400 today in a big, meaningful way for the first time ever. Again, very difficult to trade ahead of earnings if you don't have a signal. Follow the discipline. That's the key to making money in earnings season. There's earnings season 4 times a year, so you don't have to overplay your hand in any given earnings season. Now, I'd like to end the webinar by looking for buy ideas, because we do think that the market's going to have that rally to new highs. I don't think we're going to see a test of those lows at 2350 or even 2500, with the S&P closing in the 2740 area. We just don't feel as if we're going down, and a lot of people are missing out on this rally. So here are some stocks that we do like and have liked. We've been talking about Salesforce.com since back in December, when the stock was trading at 135, ultimately made a double bottom at 120, relative strength buy signal. We jumped on that one in our webinars, and the stock has moved out, leading the market to new highs. Power gauge is bullish. This is now looking like a classic bull again, outperforming the market. Chaikin money flow is extremely strong. So you're looking for these pullbacks, like this pullback under 145, to get long the stock or put on a bullish vertical call spread, which is what we really like. Cadence Designs made that my bullish stock of the week 2 weeks ago in Chaikin Analytics, really a week and a half ago. The stock was trading at around 46. It spiked up to 51 yesterday, was trading around 50 when I pulled this chart this morning. Again, computer software stock, similar to Salesforce, but a very specialized set of software for semiconductor manufacturers, only 3 people in the whole industry. Bullish power gauge, outperforming the market, strong Chaikin money flow, but extremely difficult to buy. You have to buy pullbacks in order to stay disciplined. And here's a company that I actually just read about on Super Bowl weekend, Zebra Technologies. And Zebra's had a bullish rating off and on for over a year. It shows you how challenging 2018 was, a lot of choppy action in the stock. What Zebra does that brought it to my attention is they make chips that are now being put into football helmets, shoulder pads, footballs themselves to track the speed of an athlete, to track a lot of different metrics that metrics-oriented general managers are using to make trades, to make draft choices. And when I looked more deeply into Zebra, what I saw was a bullish power gauge rating and a stock that's on the verge of making a new all-time high, on its way to 190. And again, with the stock oversold right before Super Bowl Sunday, pulling back to the 21-day average, classic low-risk entry point that we try and stress in these webinars. Now, everything we've talked about is in Chaikin Analytics, which is a proven stock selection system. And we've got those daily email alerts to let you know when things are happening. Normally $2,195 for an annual subscription. You can go to chaikinanalytics.com/earnings. But as a webinar special, we'd like to offer $200 off, reducing the price to $19.95. chaikinanalytics.com/earnings. That offer expires on February 9th, Saturday. You get our screener, which we didn't go into in this webinar, our options play, options ideas that are embedded into Chaikin Analytics. We license from a company called Options Play. Plus, as a Chaikin member, you get member-only access to our weekly strategy webinar run by Josh Minlin, who hosted the webinar, along with our market strategist, Dan Russo. Unlimited coaching, including one-on-one coaching. That's what makes Chaikin special. We want our subscribers to succeed, and you get Dan's daily morning insights. But here's the best offer we've made in 2019. When you call today, we'll take an additional $200 off, reducing the cost of Chaikin Analytics from $2,195 to $1,795. And for the first 6 people who call tonight, we'll arrange a one-on-one phone call with me at your convenience once you've had a chance to get to know the system. So fast action bonus, call today, save $400 on the cost of an annual subscription to Chaikin Analytics, and be one of those 6 people to get that one-on-one phone call to talk about how Chaikin Analytics can help you be a better trader or investor. With that, I'd like to thank you for taking time out of your day to listen to what we have to say here at Chaikin, and turn it back over to Josh to wrap things up.
Mark, thank you so much for your time tonight and for presenting to everybody. Everybody, thank you for attending. To join and to take advantage of Mark's incredible offer, please give us a call at 877-697-6783. My colleagues can get you set up and running. We can have you on one of our onboard sessions. We have all kinds of great member content. And as Mark said, one-on-one sessions for anybody who wants, starting with a one-on-one with Mark himself. So you can call us 877-697-6783, or go to chaikinanalytics.com/earnings. I put the link into the chat window, so you can go directly there. The fast action bonus will automatically be applied. The discount will automatically be applied. Again, that's chaikinanalytics.com/earnings, or call us 877-697-6783.